Now we will start our unit today. We have to discuss unit 9 and 10, that is for BEC, Business Environment and Concepts. Broadly, we are going to discuss short-term financing and capital budgeting. The other topic is capital budgeting and corporate performance. Broadly, we are going to discuss how to get the money, that is short-term financing from the banks. Then short-term financing from other sources, what could be the other sources for us to arrange the money. The capital budgeting process, what is capital, what is budgeting, what is the process, these three things we have to understand. Discounted cash flows, that is DCF. Then payback and discounted payback methods. Ranking investment projects means if we have 6-7 projects to choose which we should go for, so what are the methods that we should have to use it, to rank the investment. Then we will do one comprehensive example of the investment decisions along with the risk analysis and the real options in capital investment. In the last portion we are going to discuss corporate performance measures and measuring leverage with solvency ratio, that is your financial leverage and operating leverage. Before I start, I will just give you a picture that what we are going to discuss today. What we are going to discuss is highly practical for those people who are involved in projections, feasibilities, financial modeling, financial analysis, and they, in some capacity, they are assisting management to take decisions in terms of investment in a new project which useful life is 5 years, 10 years. It's if you are CFO of Nestle, you want to open a new factory in Kenya, or you want to do some other business. Before that, what calculations, what figures, what amounts you have to keep in mind, what are the methods that you should have in your minds. Then this is the broader perspective of what we are going to do. For any business we need finances. There are two types of major finances. One is the equity financing. If we sell the share capital, we get the money. The other is debt financing. Debt financing is you take the loans from the company, you buy goods on credit, this is your creditors, liabilities. Then you can issue the bonds and for long-term period of time, that is your again a liability. So this is debt financing. Then we have equity financing. This all will bring money to the business, and this business will generate further activity for long-term investment. And this investment should have a capital budgeting. What is capital is accounting term which means long term. That is used for fixed asset. Any asset which useful life is more than 1 year. It may be 5 years, 10 years, 25 years. This is depend upon the situation. Then budgeting is a plan, is a forecast which is based surely on certain assumptions based on your last year financials, last 5 year financials. In 2007 your sale is 1 billion, in 2008 2 billion, in 2009 1 billion, 2010 you are somewhere 1.5 billion. So what would be the sale in 2011, 12, 13, 14, 15? This is your forecasting. This is called the plan, profit plan, or the planning for the future, comes in the spectrum of budgeting. So capital budgeting is a future plan for a capital investment, for a long-term project, for a long-term investment asset, which may be a plant, it may be a full-fledged project having using all factor of production. For that, what is the procedure? We have certain project, which project we should use, we should choose, and what should be the scientific calculations for that. This is what we are going to discuss. Then for any capital budgeting process, we have to use the concept of time value of money. money today will $1 will be not $1 after 1 year, because money loses its value over the period of time. Suppose in 1970s $1,000 is more than enough for the upbringing of the kids, buying a house, and for all day-to-day livings. But today $1,000 is nothing. It's not sufficient for a single person cost of living. So means money loses its value with the passage of time. So if someone comes to us and he says that this is the project, 25 years, after that you will get this much money. So naturally, as we have a time value of money concept in our mind, the first question will come that what would be the present value of this future cash flow that we will get in 25 years after. What is the present value of today? So we can decide that this project should we go or should we not go for it. For that we use the concept of time value of money. We calculate the net present value. Net present value is a value which is showing the worth of any future cash flow as of today. We have two methods to see that investment is good or bad. One is called net present value method. The other is IRR, that is internal rate of return. In fact, both methods are almost the same. Just the functioning of the method is little different. Otherwise, the way it behaves is the same. Now we should have inflows, outflows during the project life. That will be 25 years maybe. First few years you will go for outflow. Every project starts with generally outflow. Right. You will buy the land, you will give contract to someone to build a plant, equipment, you will pay to supplier to bring the machinery, make it workable. So first few years it will be outflow, then it start inflows. Now we have to discount it. What is discount? Discount is a term that is given by statisticians by calculating based on their calculations that today the dollar in 0 year, that today is 0 year, we are going to invest something, $1 is equal to $1. But after 1 year this is 0.948, and after 2 years this is 0.9100, after 4, it's losing money every year. So we have to calculate the year and the discount rate one by one. It will become the net present value. If it is positive, so we should go for this project. If it is negative, we should reject this on spot. Same way, IRR method is the same, outflow, inflow, multiply with the discount rates, get the present values, and select that project where net present value is equal to 0. Where NPV is equal to 0, in IRR method, this is the best project. NPV method, net present value method, where the answer come more than 0, 1, 2, 3, or positive. This is the project that you should go for it. This is the bottom line we have to keep in mind. And this is based on inflows and outflows, which is more practical way to think in terms of cash. But there are some accounting knowledges. Based on all accounting, they calculate net income, expenses, net profit, net loss. So if you take the accounting values instead of cash flows, accounting profit and loss, then this method will come in payback method. Payback is a simple term. Every owner, that either you or any big investor, when it comes to the investment, he asks a very simple question from the investor, that what is this money I am giving you, in how much time I will get this money back. This is payback. Means you spend 100,000, in 2 years you get it back. This is payback method. So it's very simple to have. you get your full investment. Every year you see how much profit you get, and 2 years, 3 years, this will be your payback period. After this 3 years, whatever money you will make, that will be more than your payback, more than your investment.